Welcome back to Over the Horizon. Thank you so much for joining me today. Today, I'm here with Eric Jackson, the founder of EMJ Capital and the de facto leader of the Open Army, searching for several different 100 baggers in the U.S. stock market. Eric, thank you so much for coming on the show.
Thanks a lot for having me.
Absolutely. So, you've kind of exploded in popularity over the last several months, as has Opendoor. New leadership team, their stock has appreciated to a tremendous degree, in no small part thanks to you and your efforts. Why don't you tell the audience a little bit about your effort here and what you're trying to do with kind of cultivating this retail fan base around Open?
Sure. Well, this was a stock that was like within days actually of getting delisted. So
Mhm,
maybe 3 months ago, it hit an all-time low of 51 cents
mhm,
after coming out with a lot of fanfare in 2021, sort of as a SPAC company sponsored by Chamath Palihapitiya, and having like really renowned investors, as co-founders like Keith Rabois, and sort of having the story around them that they were going to be the Amazon of real estate. And
mhm.
yet it didn't work out that way after they
Yep.
listed as a public company, because essentially they ran into the kind of a buzzsaw of the Fed hiking interest rates by 450 bips in just a few short months. And so that, as you can imagine, really hurts their business model. They're trying to disrupt the traditional real estate model, and where we use agents and have to pay the agents like 6% commission for the hard work of selling our houses, which we don't always see value in. And Opendoor promised to kind of disrupt that. You could go to their website or their app, type in your address for your house. They would give you a quote for your house, and if you agreed to it, the money would be wired, within a 30-day period or something like that. So kind of a much shorter, simpler, more straightforward process. But
Mhm.
with the interest rate hike, they just like they got stuck holding the bag on a lot of houses that they had purchased at higher prices in 2020 that they had to sell at a loss. They went through some leadership changes, and then with the new leadership that came in, they just never really were able to show much meaningful progress in terms of the turnaround. So that's why the stock sold off. They
Mhm.
were, at 51 cents. They faced delisting by Nasdaq, and so they had a plan to do a 50-to-1 reverse share stock split to try to artificially get the stock price higher. When I sort of started looking into the company in the end of June, beginning of July, I did see some signs of hope though on the horizon. One is that the company, finally cut enough staff back that they were signaling that they were going to be profitable, at least EBITDA positive for the first time in 3 years.
Mhm.
And that's an important milestone, I guess, for any company, similar to like the Carvana turnaround story, where
Mhm.
they like faced the challenge of higher interest rates and a new business model where they were trying to disrupt the used car market. They were able to show that they could get to sustainable profitability, and then once that proof sort of set in, their stock price really started to rapidly rise. So my hope was that there were signs of life for Opendoor, but
Mhm.
also it didn't take a rocket scientist to realize that the Fed was on the verge of cutting interest rates, hopefully meaningfully over the next couple of years, and that was going to provide relief and sort of jet fuel for Opendoor's business, because as rates come down, that's going to unfreeze that U.S. housing market, and lead to like much higher volumes for the Opendoors of the world. So that's what attracted me to it. Like I did see 100 bagger potential, even when it was like 50 cents, 60 cents, 70 cents. But coming out when the stock's that low and has been forgotten about, and putting our $82 price target on it, I mean, it did evoke a lot of jeers and skepticism. Um, but it was also such a big number and such a kind of a random number, $82. People would say like, why not 100? Why not 75? I think it sort of stuck in people's minds, and
Mhm.
it ended up kind of helping to build a tremendous retail momentum behind the name. And I think it's become the biggest retail movement since probably GameStop from a few years ago, and
Mhm.
so it's been quite a ride ever since.
Very well said. I want to ask you, I have a couple of questions. This is an amazing interview. Again, thanks so much for coming on. I want to ask you about compensation of the C-suite and how you think that needs to be done. One of the things you were very, very vocal about, I think you still are to this day, is about how the C-suite should comp themselves, particularly when it comes to periods of underperformance. Um, what do you think an ideal C-suite compensation structure looks like? All the way from the president and CEO to anybody who is on the executive leadership team. Because one of the things that we saw with the prior leadership team was insane compensation, right? You know, you're looking at close to $70,000 per month at a time when the business is struggling to a tremendous degree. You're not aligned with shareholders whatsoever. And so, in your mind, what does the perfect C-suite comp structure look like? And you know, with the new management team, obviously the people who founded the company, Kaz back at the top, um, what do you think an ideal comp structure looks like so that it's aligned with shareholders?
I agree with you that I think this management team, the prior one anyway, um, I think they got used to the fact that when they came out of the gates as a public company, they were, I don't know what they were, $5 billion market cap company or something like this,
Hmm.
and yet they shrunk. So like at 51 cents a share, like they were a less than $400 million market cap company. And yet, I think like human nature being what it is, like you still think of yourself as this like big, important, much larger company. And that leads to like much larger compensation and all this kind of stuff.
Hmm.
I don't know. My biggest beef, obviously, like executives, are going to have to pay themselves, and it seems like every year, the social comparison goes on where you're an executive, you sort of look at these other public companies where other people that you think you're just as good at if not better than, are getting paid a lot. Like all this sort of leads to sort of like an upward spiral of comp. I don't think you can ever change that. What really aggrieved me, though, as a shareholder, was that the prior CEO, Carrie Wheeler, and then a couple of other of the executives, like there's a woman named Sydney Schwab, I think she still is the chief legal person there.
Hmm.
They were
Yeah. Realize.
they received all these things called RSUs, restricted stock units, which is
Hmm.
basically like found money for these executives. It's sort of like free shares. It's like, here, as part of your comp plan, in addition to your cash compensation, here's a bunch of free shares in Opendoor. And these executives know that whenever they sell shares, the market takes it as sort of like a signal that maybe they don't have confidence in their companies. And so
Hmm.
if you just sort of wait to periodically dump shares, you could, inadvertently tank the stock price when you do that.
Hmm.
And so they have a tricky way of getting around that, which is something called a 10b5-1 plan, which is where you register in advance with the SEC and you say, I'm an executive, I'm an insider, but I don't have any insider knowledge that's like making me negative about my company. I just want to make a grand announcement today that over the next, whatever it is, 6 months, 12 months, I'm going to be periodically selling shares, maybe once a month. And therefore, you can't accuse me of lacking confidence in the company. I'm just
Hmm.
diversifying my financial concentration away from Opendoor to, so I can buy rock companies or whatever, plastics companies or something.
Hmm.
And then they just dump and dump and dump. So that's what was going on at Opendoor. That's what was really annoying as a shareholder, especially when Kerry, the CEO, at 56 cents a share, close to the all-time lows, did a big stock dumping onto retail, and it just doesn't seem like very aligned with the shareholders who have to dig into their own pockets with and spend their own after-tax dollars to buy
Hmm.
shares in this company. It's just not on the same page, and so. Especially also when you look at a company like Carvana, which I pointed to as
Hmm.
sort of like should be the playbook that the Opendoor people should have been following for a turnaround, because their stock went from $400 to $3.50, and now it's come all the way back to $400. One of the
Hmm.
things about the Carvana management team is that in 2022, when their stock was really tanking, there were several insiders on the executive team and directors who dug into their own pockets and bought a meaningful amount of Carvana stock themselves. As and they did that not just as a symbolic kind of gesture to shareholders to say like we feel your pain, but really because they believed that the company was really undervalued and they saw
Mhm.
thought it was a great investment and a great way to spend their money. So I think like that, now Kaz has come in and he has this compensation plan that was architected by Keith Rabois. He's the new, now the chairman. He's like the co-founder, one of the co-founders of the company. And the comp plan is basically $1 a year in compensation. But like as the stock price for Opendoor goes up and crosses certain thresholds, that's that those thresholds act as releases to like stock for Kaz. So, he makes a lot more money as the share price rises.
Mhm.
So I think I worked it out that like in my now like bullish of like blue sky scenarios, I think like in a few years, like 5 years down the road, it's not guaranteed this will happen, but like I do think it's achievable. Like Opendoor could become a $500 stock, and so if that did happen, Kaz's release will get obviously the full release of his stock, and he would be worth something like 41 or 42 billion dollars. Which I have no problem with because as a guy who got in at what the 70 cents level, I plan to hold. I have no problem with executives getting fabulously wealthy if they do a good job and create value for the other shareholders. It's when, they're shrinking value and they're still like, you know, cashing in on like
Mhm.
big checks and stuff. I think that's totally out of line.
Absolutely. Yeah, no, I think from the C-suite all the way down through the high-level executive and management team, it's not just about, yeah, you're right. It's not just about imbuing confidence to the shareholders, but it's about whether or not you actually believe in this company or whether you're not kind of like a PE-ified, private equity-ified sort of type manager of a company where you're coming in, you're getting a huge salary, you're saying the right things on television, but you don't actually care how the company's doing. You just want to get cut big checks until you get fired and then hired by the next firm. We've seen kind of this strategy of corporate management, and it hasn't done very well for many brands. I think there's a huge shift back to caring hugely about fat, particularly now that money actually costs money, that they're coming down, but real rates are positive for an extended period of time. I think people care more about having a leadership team that's actually aligned with shareholders. Um, Prime example of somebody who's actually extremely confident in the future of Open is Eric Wu. He purchased 300,000 shares of Open. Um, so obviously somebody wouldn't load up on shares. An insider like that would not load up on shares if they weren't confident about the future of the company. So that's what I love to see. I want to ask you about this idea of a rising dynasty, right? The kind of notion that retail investors can go and get theirs. This is a huge trend that came about in 2020. I was fresh out of high school when all of this happened with GameStop. I was in my freshman year of college. I remember vividly they kicked us out of school because of COVID. Later that year, GameStop, roared, and a lot of my friends and myself dumped, whatever capital we may have had into GameStop, and that was a huge moment. The rise of that gave rise to Wall Street Bets and all these other communities, and this general idea that retail can get behind an equity that they like, and they can make huge sweeping changes to the management team and the way that the company is run. So I wanted to ask you about kind of the power of retail and what this rising dynasty movement that you're working on is all about.
Sure. So I mean, I didn't have a grand plan for a rising dynasty when I started my position in Opendoor. But
Mhm.
obviously, I noticed that there were a lot of people that immediately were attracted to Opendoor, and they came from the middle class, and
Mhm.
they were retail shareholders. They were excited about the idea of this thing being a 100x opportunity. And they could kind of do the math and figure out like what their stake in Opendoor would be worth if it truly achieved that, and how meaningful it was. And so we're still far away from 100x, but we've gone from whatever 70, 80 cents to now $8. So I think it's been
Pretty
a
clean 13x, 14x.
right. So, but I even now like I'll get private DMs from people or messages where they'll say, "Oh my God, I just paid off all my credit card debt, or I just paid off my student debt, Eric. I can't thank you enough, for doing this." And really real heartfelt messages and real messages. And you can tell that these are people that are working really hard. They are, sometimes they're working regular jobs, as a painters or electricians or fishermen, and they're not glamorous, but they know that they're not going to get rich just from the paychecks that they draw from those jobs. And so
Mhm.
they're thinking in the backs of their mind about like what else can they do, and like so. I mean, there's only so many things you can do to like increase a significant amount of wealth for your family. It's maybe in the old days, it would have been like flipping houses. Now there's like sports betting ads everywhere we look on TV. I mean, you could play the lottery,
Poly
but
market. Yeah.
yeah, I mean, sure. I mean, lottery tickets, but most of
Mhm.
us know that's not going to be like some guaranteed success. So I think more and more people are getting interested in the stock market. And even like I was just in Germany a week or two ago, and
Mhm.
some guy like sought me out in Germany. He figured out like I was in Frankfurt, and I was speaking at a conference, and he'd sent me a message earlier in the day like, "Hey, can I meet with you? Can I buy you a coffee? I've made some money on Opendoor, but I'm like." I wanted to ask you about like some challenges I'm facing in my life and stuff. And he ended up like I couldn't respond because I got busy. So he ended up like coming to the conference, like finding me in a hallway, asking if he could take me to a coffee. And we did. And he wanted, he was 31 years old. He's like in tech sales, but he really wanted to break into investments and wanted some advice along those lines. And he was telling me about his own challenges as a 31-year-old guy with a young, 11-month-old baby
Mhm.
at home, and how difficult it was to buy a house in Germany. And anyway, it just made me realize that there's something bigger going on here about, like, and that it's not just in the US, it's like around the world, where a lot of younger people, a lot of middle class people just like are struggling to kind of get ahead. And I think they've been fed a line from Wall Street, where typically like the people shilling these passive ETFs say, you're stupid, retail, you're dumb.
Right.
You lost all that money on GameStop and AMC. That just shows how dumb you were. Trust us. The only way you can make money in the market is giving money to us and paying us fees to be sit in our passive ETF that will mimic the S&P 500 or
Right.
whatever. you know and I just think that's you know I'm not, there's a place for benchmarking to the S&P or NASDAQ or whatever, whatever you want, but I don't think anyone's going to get fabulously wealthy investing in ETFs. I think when you look at the people who have really broken out and become successful, usually they've had one or two or three meaningful investments where some people would say they got lucky. Other people would say they
Mhm.
were smart and they kind of, zeroed in on one or two or three companies. And I think that's possible for retail. I mean, the people that I meet with and talk to, I mean, are not stupid in terms of retail investors. They are smart. So, even if they're whatever, painters or just doing some kind of regular Joe job. I mean, there was a guy who came to my house and the beginning of this year. I think we had a leak in one room in a ceiling, and he was just like touching it up. And we ended up getting into a discussion about quantum computing. And this guy knew as much about quantum computing as I did. And we were, comparing notes about particular quantum stocks and so forth. And you could tell like he really saw that as sort of like an avenue to jump the line in terms of his position in life and stuff. So all this like led me to kind of realize, especially after I had this coffee with this guy in Germany, that rather than being seen as the guy who's just banging the drum for Opendoor, which obviously I believe in, and I think it is a valid, a great 100x opportunity. Um, I think it's bigger than Open, and that's why I sort of wanted to kind of capture this idea of like rising dynasty. It's like I think everybody who's in the middle class who like busts their butt trying to help their families, or maybe it's trying to, save to buy a house. Like, I think stocks can be a really great a vehicle to get ahead. And I'm not saying it's going to be easy. I'm not saying like you're not going to make mistakes and you're going to lose money, but I think you need to kind of devote yourself to self discipline, self education, I mean, we're lucky that we happen to live today in a world where we can just all tap away into chat GPT and kind of have this like amazing kind of knowledge resource available to us, almost free. I mean, I invest in the whatever it is, $25 a month, the version of chat GPT. And it's an amazing resource. So I just think, you as a retail investor, you should know, like, you're not alone. You're not like facing this struggle like on your own. That we're all out here together trying to learn from each other. And I mean, I'm not going to make any money from some guy. Like, there was a guy yesterday I talked to on the phone. He's a fisherman in the
Hmm.
Bering Sea. He's from Alaska, and he's out 4 weeks out right now, catching cod in Alaska. He's leading this team of other, guys on his crew, catching cod, and they're gonna probably be out there for another 2-3 weeks, either until they run out of bait or they run out of diesel fuel, and they'll have to go back in. And he sent me photos and videos of like the 40-foot waves they deal with every day. But they're, a lot of them are open investors, and we were just talking about how, he sort of resonates with this rising dynasty idea. And so I just think, like, this is worldwide. Like, and we can all help each other. We can all learn from each other. I mean, I'm not going to make any money if he makes money, except, obviously, if I'm an open shareholder and other people buy open, I mean, and that helps it go up. I mean, I guess I benefit that way, but there's no sort of direct fees for me from
Hmm.
this. But I just know how much it means to people. And I want to hopefully inspire some people to kind of just keep pushing and keep learning and growing, and don't buy this line that you're stupid or you can't do it yourself.
Extremely well said, particularly to the point about us having access to these wonderful tools. I mean, you and I are talking from, conceivably hundreds of miles away. I'm in New England right now. I'm near the Boston area. Hundreds of miles away from each other. We're talking with near instantaneous feedback, almost zero latency. We can fire up ChatGPT, we could fire up Grok, we could fire up Claude, and increase our total workload capacity by 10x, right? And anybody can have access to these tools. And so it's kind of this democratization of these tools, but also the democratization of finance with the rise of Robinhood, which was, a couple of years before GameStop really exploded in popularity. And I think, the rise of things like Better, other sports betting sites. I know Better is one of the stocks you have listed in your on your X profile. It's kind of this rise of, some call it financial nihilism, right? Where the difference, the disparity between the haves and have-nots, particularly post 2020, is never wider, right? Rents have doubled. They're not moving down. Price inflation is sticky at 3%. It's not coming down. The Fed has said that that's its new long run target. Asset prices inflated to the stratosphere. At the same time, real wages simply aren't keeping up. And so the non-asset owners now need to do things like this in order to kind of get from here to there to where they want to be, to close that gap, as you said, and kind of get to the next rung in life, kind of skip the line. Um,
Hmm.
so, speak to kind of the rise of kind of this movement. We call it, in the Bitcoin community, we call it financial nihilism. We say that Bitcoin is a very, very good way of storing value and not doing much else. But how popular would you say this movement is in the United States? And do you think, from a financial markets perspective, do you think we'll ever get back to a world where that gap closes, right? Where the bar to become an asset owner falls? Or do you think that it's only going to get further away and more people are going to be driven to do things like this, like sports betting, like gambling, like buying stocks?
Yeah, I'd like to be optimistic, but I actually think it'll just keep getting wider and wider.
Mhm.
Um, I remember meeting this woman, Christia Freeland, for a coffee. This is probably like 15 years ago, and at the time she was like some editor for Reuters and living in
Mhm.
New York, and she had wrote a book on this subject. I forget what it's called, but it was sort of like talking about the haves and have-nots and how the distance was getting wider.
Mhm.
And I remember asking her at the end of the interview, like, well, what ideas do you have for bridging this gap? And she really didn't. She really didn't have any in that interview. And then she subsequently she moved back to Canada and she became a politician. And she worked for Justin Trudeau in government for like almost 10 years. and her last position was as like the finance minister of Canada. And yet, and so you'd think like if anybody would have, in her heart, the goal and ambition to uh, close this gap, it would be her and then her government, and they would like seek to do this. And of course, they paid lip service to it. I mean, they were a liberal social democratic government. I would say they're almost verged on communistic, like
Mhm.
in terms of their approach. Like it was very far left, and I wasn't supportive at all. And yet, the gap's only widened. After 10 years and three elections of their government, like it's only widened, and so it's a challenge for sure. And so that's why part of my messaging with this to the like I guess real people who are kind of stuck in this situation where they are struggling to get ahead is I would say like if you're expecting like a politician to show up on your door and like drop a
Yeah.
bag of money in your lap, I mean, keep waiting. If you're waiting for your boss, if you're whatever in your job, to suddenly like pluck you out of obscurity and give you like a big promotion, like maybe it'll happen, but I mean, don't count on it. I mean, we're all
Mhm.
facing the challenges of like our is AI going to disrupt our jobs? So I think it really has to come from within yourself, like
Mm.
and therefore, and that only comes through like self education and knowledge, and using of these kinds of resources that are available. I was at some conference just a couple of weeks ago. Anthony Pompliano had this like individual investor conference in New York.
Mhm.
He was interviewing somebody, I don't know who it was, and I was just sort of like in the audience. I walked in, and he was giving the advice that every day you should use Chat GPT, but there's a voice, there's like a Siri version of Chat GPT where you can like talk to it and like
Mhm.
basically ask it questions like similar to how you might, ask Siri questions. And he said it's kind of like the equivalent of like talking to 150 IQ person, genius, like having that genius like be your best friend and just like having a conversation with him. And I've used it, and it is truly powerful. It's like we've all gotten used to Siri being kind of a blah kind of disappointment, but that version of Chat GPT is I don't even know what they call it, but it is powerful. And his message was just, just ask it questions, like just, you're, try to, follow where your interests take you, and start having this conversation, and you'll learn, and you'll, learn to ask new questions.
Mhm.
I think that's the only way, like, and then channeling that into investment ideas, not just broadly dispersed across an index, but like specifically around one or two or three names. That's really the only way that you are going to get ahead, is if you put
Mhm.
a meaningful amount of your own personal portfolio behind, like more wood behind like this, like one kind of idea that you think is going to be, a 10x, a 50x, a 100x, and not over trading it. That's the other thing that I think was sort of a lesson from the whole GameStop, version one, version of this kind of retail movement is just like, a lot, oftentimes like you would have done much better had you just sort of bought in early and stuck with it rather than trying to trade in and
Mhm.
out of it.
Yeah.
I think the other thing is that the companies that were part of the meme stock movement in 2021, like AMC, I mean GameStop, like me personally, like I wouldn't be interested in owning any of those kinds of companies because I don't think they're
Mhm.
long run sustainable businesses. They're not a Carvana. They're not an Opendoor, which I would say are like I don't call them meme stocks. I call them cult stocks, meaning
Mhm.
kind of they're long term compounders. They're like similar to Palantir. Palantir was, some people called it a meme stock, or it was crazy stock. It was too expensive. Like even at $5 a share, people would go on TV and complain it was too expensive, and because it was a government contractor and so forth. And yet it's
Yeah.
proven now, like at $180, like, oh yeah, no, like the retail people who got behind it early and saw something in it, they were right. They were vindicated. This was like a sort of like going to be at the forefront of AI, and they were smart to get into it. Tesla, there was like some people that hated Tesla 10 years ago, some people that absolutely loved it and thought Elon walked on water. Those bullish people were proven right. and they
Mhm.
were smart to kind of get in early, and they've made whatever 15x or something. So you got to find these kinds of opportunities that you believe in, put your money behind them in a meaningful way for you, whatever that amount is, and just kind of stick to it, and hope, see it as like a 2, 3, 4, even 5 year kind of investment horizon. But if it works
Mhm.
and it hits and it's a 100x opportunity, that is going to significantly impact your financial life and your family's life.
Absolutely. I think, it all boils down to conviction and then whether or not these companies have a long-term trend, right? Companies may look very similar on their face, right? Particularly from a unit bias perspective. Two companies may be valued at $5. One may have a market cap of 500 million. One may have a market cap of 500 billion. And so it's all about identifying that, but then also having the conviction to understand where the world is headed and whether or not these companies are actually building for that world. Palantir is a prime example. Tesla is a prime example. Carvana is a prime example. And so if it's simple, new, and liquid, and it's extremely undervalued, developing the conviction behind it, and then putting your weight behind it in a way that, a 50x could change your life, but a 90% drawdown wouldn't destroy you, right?
Right.
That's very powerful. And it's almost like, to your point about ChatGPT, every human being, right, regardless of education level, now has the tools to, massively increase their marketable skill set, right? You could use ChatGPT as a tutor. You could also use it to supplement your thinking, right? You could lean on it and rely on it, or you could leverage it, right? And so it's kind of that battle, right? At the same time that, from a financial tools perspective as well, Robinhood is around, right? At the same time that you now have democratic access to purchase these stocks from your phone with basically zero fee. Um, on the flip side of that, there are other options as well that are calling your name. Hey, why don't you try options trading? Why don't you try a 16-leg parlay on the Red Sox game, right? At the same time that there's so much opportunity on one side, there's so many things begging for your attention on the other side that you have to fight this. But if you can really harness this and leverage it, you could really transform your wealth and transform your future and your family's future. It's solely about focus. And so, do you have any advice to the listeners who may be trying to do this? They're trying to develop more marketable skills. They're trying to learn and leverage these tools to the best of their ability. Do you have any advice for them for fighting off the other things that are begging for their attention that this technology also enables?
Well, I think everyone's always looking for shortcuts, and
Mm,
that's understandable. But like zero date to expiry options, like options
mhm,
that expire, Friday of this week, for example, like that's usually like when I look back on my own career as money manager, like the greatest way I've like incinerated value is for my investors is by leaning too heavily on shorter dated options,
mhm,
that where my thesis might have been totally correct about a company being whatever the next Carvana or whatever, but those options, expiring too soon, you just don't you don't have, because Trump says something and roils the markets, or some macro event happens with, like, the bombing in Iran or something like this. Like, you could be totally right about your view on a one particular company, and yet you've lost all that money that you spent on those options. So
mhm.
you need to be cautious with that. You need to be cautious of, like, I don't know, some sports 16 leg sports parlay or something like that. I personally, like, don't, have never been attracted to that. Um,
Mhm.
and kind of just focus on these ideas that are could play out in 2 or 3 or 4 years. I mean, that's usually like that can be to your advantage, I think, because everybody's always looking for the quick hits. Like on CNBC, like they have the show called Fast Money. They don't have a show called Slow Money.
Yeah.
And because like everyone's like wants the dopamine rush, like what's the trade I can get into, what's and get in and out of. I have a friend who, like, I suggested he get into Opendoor pretty soon after I got into Opendoor. And one of the things though that he did is that he didn't just like plunk his money in at a very low, I don't know what it was, in the ones when I told him about it and he first started trading it. But he's the kind of guy where, like, every day he has to be making a trade of some kind. So sometimes, and he would tell me, like, he'd be, oh, I sold my calls on this, and I did this like version of that, and like it was like very complex, and it sounds exciting. And I think he's the kind of guy that he just loves the juice of like doing something every day. Like it sort of makes him feel
Mhm.
like, he's exerting his control on this trade. He's putting his mark on it. And yet when you look and you sort of stepped back and you sort of assessed, I don't know, a month or two later, he would have made much more money had he just like put in his big chunk right at the beginning and the ones, whatever it was, and just done nothing, the whole time and just sort of let
Mhm.
the thing sort of play out. And yet he couldn't do that. I don't even know today whether he's learned that lesson. So, I mean, try to learn from that. I would say,
Mhm.
develop a point of view. I mean, you're gonna make mistakes. Sometimes especially early in your investment career, you'll think you found this like amazing opportunity, and then it doesn't pan out the way you expect, and you'll only realize later, like, oh yeah, I guess because of this, because of that, I didn't take that into consideration, and so forth. And that's part of the whole learning process. And then hopefully it makes you the better investor for the next opportunity that comes your way. Like another friend of mine said to me, Eric, like the stock market it's like waiting for a bus, like there's always another bus coming. You don't feel like you have to like totally like, it's not the be all and end all that you make all your money on this one trade. I mean,
Mhm.
like, and you got to make sure you don't lose all your money, so you can't take the bus anymore, right? So you got to keep enough money on, going that you can take your crack at the next opportunity that comes along, and just sort of keep that in mind as well. Like, it's a long game, and but even though I'm saying like, you know, take a step back. You don't want to like lose all your money in one shot, which is true. You also have to realize like 100 baggers are pretty rare. They don't
Mm.
come across every day, and so when you do see an opportunity and you really feel it in your bones that this is a big opportunity, I mean, you can't be afraid of like, putting a significant amount of money of your own capital, behind it, because, you might not see another one like that for another 2, 3, 4, 5 years.
Mm. Absolutely. You know, not trading for trading's sake, right? I think a lot of people misunderstand. They love the adrenaline rush of doing something like, oh, geez, I think, back when Twitter was public, Twitter is going to post good earnings. Let me get, these 2 day to expiry, 3 day to expiry calls. Rather than that, right? If you have long-term conviction in something, embrace the boring, right? Don't allow your adrenaline rush. Don't rely on adrenaline rushes in order to invest in something, right? If you're relying on emotion, then that's a really, really easy way to incinerate your money, particularly when we're talking about retail, right? Because if retail is trading in size, particularly in things like options, that's a really quick way to burn all of their money versus building a long-term conviction, understanding where the world is headed, identifying value in specific companies, seeing that they are undervalued. Um, and then putting a significant amount of your weight behind it, right? And the best investment decisions you can make, sometimes you might have a pit in your stomach because of how big the sizing is. But if you have confidence in it, if it's not some kind of leverage vehicle and there's little to no liquidation risk, and it's enough capital such that a 10x or 100x could change your life, but it's little enough capital that a 90% drawdown wouldn't destroy you or your family, particularly when we're talking about retail who's trading on increasingly lower disposable income. It's very important. I think embracing the boring is the number one thing that retail investors and any investor can learn from.
Yeah, I would also point out one comment, which is that you mentioned before, like you're typically like crypto focused. I
Mhm.
love crypto, as much as the next guy. And I love Bitcoin. I love Ethereum. I think there's some big opportunities in some of the altcoins now, even though they altcoins have kind of have a bad rap these days and kind of, but one thing I notice about the crypto community is that there are some people that are kind of obviously dyed in the wool, Bitcoin enthusiasts, or, and probably Ethereum enthusiasts and so forth. And, you'll hear things like them talk about like, it's all about hard assets, just to get, I love crypto because I just don't like, this can't be debased and all that stuff, which is fine. But realize like if you were, and many of those people probably made a ton of money in Bitcoin by getting in early, in 2015 or whatever, and kind of riding that. As Bitcoin has grown, It's obviously a different sized asset today than it was, 3 years ago, 5 years ago.
$2.4 trillion dollars 5 years ago. It was, half a trillion of that.
So even though I believe, I'm I in the long term, this could be worth several million dollars. Like on a percentage basis, like you start to bump up against the law of large numbers. Um, my oldest son who's 20 as a friend who his dad is a dyed in the wool Tesla enthusiast. In fact, like
Mm,
almost 100% of his portfolio, the dad's and therefore the family's portfolio is tied up in Tesla. And
mm.
he's believe and 5 years ago it was all Tesla, and he's made good money since then, which is great. And I like Tesla, but like now I saw him, I don't know, a few weeks ago, and he was like, hey, well, now it's all about the robotics story. Like it's all sort of like the next phase of the Tesla story. And but Tesla's like obviously a much bigger company today than it was in 2018 when Elon.
$1.5 trillion dollars in size. Yeah.
Yeah, so I just think you can't be like you can't be married to like one stock forever. I don't think. I mean, I think you have to realize that it's not a religion, okay, that we're talking about here. Like, and often the best ideas, like who was talking about Opendoor at the beginning of this year, right? Nobody. And so the best investment ideas, like are often from like the corners of the markets that nobody's paying attention to. And
Mhm.
so you can't be afraid to kind of look in those like dark corners of the market for new ideas, and also just realize like as these assets, like Nvidia is great, but like now as a $5 trillion company, are they going to 500x next year? No, like it will be very difficult, right? Because the law of large numbers. So I don't think you just don't get religious. Don't get you can marry your spouse, but you don't have to marry your stock, that or some crypto coin that you come across, and just be willing to kind of keep an open mind, and look where people are not talking about when you turn on the business TV.
Absolutely. 100%. I want to ask you about identifying value. Previously, I think your Twitter bio said a couple of months ago, you may have changed it recently, the Carvana hedge fund guy. So Carvana, Iron, Cypher, these are some extremely, valuable stocks now that you were able to identify very early on and position yourself in them. And now, all three that I just mentioned have gone on to do pretty amazing things. How did you identify that value? What's your long-term thesis about the way that the world is unraveling, the way that the world is developing? Where do you see us in 10, 20, 30 years from now, your long-term thesis? And then how do you invest based off of that? How do you identify value in the companies that are going to be able to capitalize on that most effectively? One of my mentors, when it comes to investing, he's given me this kind of axiom to live by. It's simple, new, and liquid. Right. That's how you can most clearly and simply identify value when it comes to long-term trends and the companies that will capitalize on them most effectively. How are you able to successfully do it with these players? And then looking forward, how do you identify value with where we're headed in the world?
Well, I think that um, like 100x opportunity is different from like just I don't know, a 2x opportunity, for example.
Mhm.
And you shouldn't look at 2x opportunity like a gift horse in the mouth. Um, like one of the easiest ways I've found to find like good investment ideas is just to kind of be aware of like what your friends and or your family members are talking about. Like I was chatting with this guy, Captain Mike, who's like this fisherman in the Bering Sea yesterday, and he
Mhm.
was he was mentioning that one of his first like successful trades was buying Amazon when he realized that his wife and all of her friends kept buying these boxes kept showing up on their doors, right?
Right.
Where they were using Amazon. And he would ask her, like, why did you use Amazon to buy the deodorant for us instead of going down to the local grocery store? Oh, all my friends are doing it. And like, it's 50 cents cheaper for me to buy it on Amazon. Oh, okay. So like he sort of put two and two together and said, maybe I need to own this stock. So you can get ideas like that all the time. Like, my wife starts watching some show that's only on Paramount Plus or something like this, that might be an idea for an investment in Paramount, for example, if it was like getting really popular. I mean, to come up with 100 bagger ideas like the Iron and Cipher, I mean, I don't think it's. I mean, I'm usually not thinking 30 years out. I mean, I don't think anybody's got the crystal ball to tell them what the world's going to look like. Even 5 years out is difficult to predict. But you do want to find situations where maybe a stock is sort of thought of as X, and you could see that it's the potential that it could be Y. And so,
Mhm.
like with an Opendoor, like it was thought of as like a failed company, and iBuying was thought of as a failed practice for like how you would buy and sell houses because Zillow and Redfin had pulled out of the market for iBuying. And so for me though, like I looked at it and said, okay, well, there have been certain companies that have come along like Uber or Carvana or Airbnb, where they became like a national brand in that
Mhm.
particular space, and they disrupted the traditional way that we used to do things, like calling a taxi company to get a taxi to come get us, or call the B&B itself and to arrange for like to go and stay somewhere you know now we go to the brand, and we think about that brand, and they become the way that we interface with that service. We don't go to the car dealer, on the corner, and we go to Carvana and we buy and sell our used car, and they drop the car off at our house or whatever it is. And so I sort of said, well, like what else could have that opportunity to become a verb, that regular people use in their day to day, and like, well, being the Amazon of real estate, disrupting the traditional agent model that nobody seems to like, and yet we all just sort of accept that we have to do that when we buy and sell our houses. Like, well, there has to be somebody that's going to fill that role to kind of be the Amazon of housing. Who's it going to be? Is it going to be a Rocket Mortgage where like you go to get a cheap mortgage and by calling up a call center in Michigan? Or is it going to be Zillow where we go and we like browse expensive houses to see like how much is this mansion worth in Hilton Head versus like this mansion in Malibu or whatever it is? Like, is that the way it's going to get done? Or, oh, maybe it could be an Opendoor, even though they're, run in a lousy way and their stock's almost like about to be delisted. Because like what was different about them is that like last year they had 1.5 million Americans go to them and request a specific bid for their house from
Mhm.
Opendoor. And so they didn't always accept it because maybe they thought it was too cheap or whatever. But like that shows like a sort of an intention, and an interest in doing a transaction if the price met their expectations. And so I just sort of said, well, this is a company that if it got its act together, it could monetize that, like similar to the how Google monetized, all the search intent, So they seem like much better strategically positioned to become this Amazon of housing one day. And yes, there's probably a list of 20 or 30 things that have to go right for them to fully achieve that valuation. But at like $400 million a share, or sorry, $400 million market cap, like it was sort of they had 550 million cash, like so,
Yeah.
like it was so cheap, like it just seemed like with a couple of things going breaking their way, and this thing could be like 2x, 3x, 4x, and now we
Mhm.
are whatever 13x, that original valuation. So I don't know, that's sort of like a mini case study of how I looked at that particular opportunity. But you could do the same thing looking at a particular crypto coin or some other out of favor company, like, basic sum of the parts analysis, like, well, they have this much cash, their business, they're doing this much, it's being valued this way, but other companies in their space are being valued this way. Oh, like, wow. I mean, if they did a better job of telling their story, they could be worth like this much more. Having a sense of like what some exciting new space will be like when ChatGPT came out, um, it took 6 months before Nvidia's stock really took off, right? Because people
Mhm.
didn't put the two and two together, right? They didn't think that ChatGPT, was so. Everybody said it was different. Everybody said it was exciting, but nobody knew that what was powering that were the Nvidia chips, and the
Mhm.
GPUs that basically that were sort of powering that. So I think you just have to be open minded. you have to kind of realize like when big things when they come along, like a chat GPT that's new and different, and then thinking about like, oh, like, hmm, like what's powering that? Like, how's that going to manifest itself in our life? Like, what stocks are exposed to that particular new trend? Like, those are some of the ways that I try to brainstorm new investment ideas.
Very, very well said. And I think another point as well, in the vein of doing the work, as you mentioned, doing the research, identifying these opportunities, is and I'd like to hear if you agree with this, is trying to go to the primary source as best as you can, right? Read annual reports, read company filings, figure these things out, build your own thesis. I think an over-reliance on secondary sources can lead a lot of lambs to the slaughter, particularly when it comes to things like Wall Street bets and solely reading some guy's investment thesis that you read on Reddit, not validating it yourself. And I think this goes for everything, right? Trying to get to the heart of it, trying to be the primary source and construct your own view from there. Because it's also an intellectual exercise, right? And once you build that muscle out, then you have the ability moving forward to continue doing it. I think going to the primary source is one of the key things that was missed in 2020. And it's a muscle that retail investors need to develop now if they are to do these things successfully.
Yeah, I would stay away from annual reports or letters to shareholders because you got to realize those aren't written, those don't come from the horse's mouth. They go through
Hmm.
like a team of PR people, marketing people, lawyers, and it's the sanitized view that they want out there.
Hmm.
I personally I like going through earnings call transcripts or actually listening to earnings calls themselves when you get to and not just the prepared remarks obviously but the Q&A
Yeah.
where the CEOs or the CFOs have to really think on their feet, and because that can't be curated, that has
Hmm.
to that shows like for good or for ill like who is running this company and how they think and how they handle questions and so forth. Like I didn't realize that Carrie, the former CEO of Opendoor, was so bad until I heard her on the August earnings call. Or the CFO, Salim was his name, first name. I forget what his last name was. It was just like an abomination of a call, and it just showed like how I think Carrie only mentioned AI twice on the whole call, and just in passing, in a very generic kind of way, not as like this is the key to our turnaround as a company, and like we will must invest in
Hmm.
AI and so forth. Like there was none of that. So you came away from that call uh, thinking this is a finance person who has no grasp on technology, not no grasp on the product, and no vision that she's articulated for how this company is going to turn itself around from a $400 million company to whatever $4 billion company. So like that became clear. Like now it worked out because we pushed for some changes and got her out of there and got some people in there that worked out. Most people, as retail shareholders, you can't do that, but that might steer you away from an investment like that. Or you might listen to a call and you might really be attracted to how the CEO describes the opportunity that they're going after. And, it sort of starts to make sense. And you see sort of like a bigger picture that that person might be painting. And so that might draw you in. Then you might be like much more interested in that investment opportunity then. So primary sources, yes, but like try to go to the horse's mouth as much as you can.
The horse's mouth directly. The last thing I want to ask you is not just for Opendoor, but as far as real estate, I'm of the belief that it's one of the uh, industries that is the most ripe for disruption. We've seen it in vehicles, right? Whether it's, buying and selling them with Carvana, whether it is, new types of vehicles like Tesla. We've seen it in defense tech with Palantir. I think one of the key retail industries that impacts everybody is homeownership, right? Is the U.S. real estate industry, particularly residential real estate. Huge total addressable market, right? $60 trillion in size, right around there, 55 to 60 as of Q2. $35 trillion in homeowners equity. There aren't nearly enough companies that are jumping on this and going after it. So not just for Opendoor, but can you speak a little bit to what opportunities lie ahead for Opendoor and for the residential real estate market in the United States?
Sure. Like, I mean, Google, I think, has something like a $2 trillion market cap, and yet its
Hmm.
the size of the annual global online advertising market is only like 1.5 trillion a year. So Google's market cap is sort of bigger than the market in which it dominates and like has a 40% share in. And yet, like all those big numbers that you just talked about for residential real estate, or whether it's just in the US alone or globally, like obviously it's a huge market. And yet, like the biggest, I think, US real estate company is Rocket at 40 billion market cap.
Hmm.
So like a pittance, in comparison to the market size, right? And so like that's what got me excited about Opendoor. It's like where is the Google for this huge market? Like, and so I agree. Like, has somebody's got to figure out the solution for making it much more efficient, easier, enjoyable, rather than like the pain that we all have to go through and going to a real estate person's office, lawyer's office, like to takes weeks for a deal to close. And yet we all expect now to like live in our phones and not have to talk to humans, tap a few buttons, and we want everything done instantly. Like, why hasn't that come to the world of real estate yet? So yeah, that's been one of the exciting parts of these last few weeks in seeing Kaz and the new kind of leadership team come into Opendoor, is that you can see they're like fishing for ideas constantly, like looking for new ideas. And the community, the retail community who are invested in Opendoor, you can see the excitement that they have in suggesting ideas and seeing some of those ideas bubble up to the management level and being kind of grabbed upon by like Kaz and others, and saying, yeah, hey, that's a good idea, and maybe it's not the first priority of, because we got like 50 priorities we got to follow here, but like, yeah, we're going to knock these off like one after the other after the other. And I'm excited to see where we are 2 years from now or 3 years from now.
Absolutely. Well, Eric, thank you so much for being generous with your time. I think this was a great episode. Our listeners are going to get a lot of value from. Where can people find you if they want to find more of your work?
I'm on X at Eric Jackson, or Instagram, same handle. You can go there and start following me, and you'll see some of my ideas there. And if you want to learn more, like there's links and stuff that come from my bio and stuff there.
Fantastic. Eric, thanks so much for coming on.